Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a concept which is off-balance sheet financing. What exactly this is all about? I'll show you an extract over here, the table. The following table summarizes our contractual obligation of borrowing and the timing and the effect of such commitments are expected to have on our liquidity and the capital required in the future period. As you can see over here, the operating lease payment or the operating lease obligation, which is the off-balance sheet financing, less than 1 year, 1 to 3 years. Okay, no issues. Let's understand this in a detailed format. What exactly this is all about? See, off-balance sheet financing is basically your liability. The first and the foremost, that is not directly recorded on the balance sheet of the company. The off-balance sheet financing items, they carry enough significance because even if they are not recorded on the balance sheet finance, they are still the liability of the company and should be included in the overall analysis of the position or the financial position of the company. Now, how does the off-balance sheet financing exactly work? Let's say suppose ABC Manufacturers Limited is undergoing expansion plan and wants to purchase machinery to establish the second unit in another state. However, it is not having a financing arrangement, let's say for the same, and as its balance sheet is already heavily financed. In such a case, it has two options. It can set up JV, or we call as a joint venture, with the other investor or the company to establish a new unit and obtain a fresh financing name of the new entity. On the other hand, it can also chalk out the long-term lease agreement with the equipment manufacturing for the leasing of machinery. And in this case, it needs to worry about the obtaining the fresh financing. Both of the above cases are example of the off-balance sheet financing. Now, what is the purpose? What is the purpose of balance sheet items, off-balance sheet items? First, to maintain the solvency ratio, like a debt to equity ratio below a certain level and obtain funding which a company would not have been able to obtain otherwise. Second, it will be better solvency ratios, ensure maintaining a good credit rating, which in terms allows the company to access cheaper finance. Third, it makes balance sheet finance appear linear, which a prima facie may attract the investors. Now, there are some key features of off-balance sheet financing. First, it results in the reduction, or what we say, reduction in the existing assets exclusion, basically you can say that, of the assets going to be created in the balance sheet. Second, there is a change in the cap structure of the company. Third, the assets and the liabilities are both understated, and it gives a linear approach or impression of the balance sheet finance. Okay, let's discuss the off-balance sheet items. The first and the foremost item that we need to discuss in our list is leasing. Well, it is the oldest form of the off-balance sheet financing. Leasing is an asset that allows the company to avoid showing financing of the asset from its liability, and lease or rent is directly shown as an expense in the profit and loss account. So first of that, we have for the lease, it is a source of the off-balance sheet financing, as lessor basically bears the financing of the asset. And second, you can see that the conventional method to acquire the asset, which requires a large capital outlay. Third, it makes easier to upgrade technology with the changing times. Fourth, it makes easier for only the operating leases, because they qualify as the off-balance sheet financing, and the financing lease are required to be capitalized on the balance sheet as per the latest Ind AS. Second, the SPV, which is known as your special purpose vehicle. Now, the special purpose vehicles are the subsidiary companies, are one of the routine ways of creating the balance sheet financing. This way, this was the way that was used by Enron, which is known as one of the high-profile off-balance sheet financing exposure controversy. The first point on that is, the parent company creates the SPV to enter into the new set of activities, but wants to isolate itself from the risk and liability from the new activities. Second, the parent company needs to show the asset and the liability of the SPV on its balance sheet. Third, the SPV acts as an independent entity and acquires its own credit lines for the new business. Fourth, if the parent company fully owns the SPV, then under the accounting standards for most countries, it needs to be consolidated with the SPV balance sheet into its own, which defeats the purpose for creating the off-balance sheet finance. And therefore, normally companies create SPV by way of new JV, which is called as the joint ventures with some entity. The third example for the off-balance sheet financing is the HP, that is the hire purchase agreements. If a company cannot afford to purchase an assets outright or to obtain finance for the same, it can enter into the HP or the hire purchase finance agreement for a certain period with the financiers, which will purchase the assets for the company, which in turn will pay the fixed amount monthly until all the terms in the contract are fulfilled. Now, the hirer has an option of owning the asset at the end of the hire purchase agreement. Under the normal accounting, the asset reflects in the balance sheet of the purchaser, and hirer needs not show it in its balance sheet during the period of the purchase contract. It gets the balance sheet of, or it gets a benefit of the off-balance sheet financing. Fourth is factoring. Now, it is a type of the credit services offered by the banks and other financial institution to their existing clients. Under the factoring, financing is obtained by selling account receivables to the banks, and banks offer immediate cash to the company after taking some cut from the accounts receivable for offering the services. It is also termed as the accelerating of cash flows. And third point on this, there is no direct liability on the company due to the factoring, but there is a sale of some of the assets. Right? So what exactly is the significance this for the investor? See, the significance is quite clear here that, under the accounting standards for almost all the major countries, it is mandatory to make full disclosure of all the off-balance sheet financing items for the company for the particular year. So investors should take a note of this and the disclosure to fully understand the risk associated with such transactions. So that's it for the off-balance sheet financing. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.